Hi everyone, this is Gráinne Thornbury here working with Seamus Kavanagh in the IIFA office. You're all very welcome here today for our webinar on Customs Awareness, Section A of the IIFA Customs Clearance and Practical SAT Completion course. Now we all know that customs is such a vast and complex topic, so for the purpose of this webinar we're going to concentrate on imports into the EU. That is, goods originating outside of the EU, otherwise known as third countries, such as Australia, China, South Africa, USA. This is now a very exciting time for customs, as the Union Customs Code recently came into effect on the 1st of May 2016. A lot of new changes have been implemented and many more are still ongoing. We'll cover some aspects of these changes during this webinar. Also, I would just like to mention that the UK voted to leave the EU in a referendum held on the 23rd of June 2016. The negotiations for Brexit are still ongoing, and so at the moment there are still 28 member states in the EU. During this webinar we're going to cover the following topics. Union Customs Code, UCC. This new code came into effect on the 1st of May 2016. Customs clearance in Ireland. Prohibited restricted goods. Customs duty, excise duty, VAT, VAT-free authorisation, electronic customs comprising of the import control system, economic operators registration and identification system, authorised economic operator, declaring goods to customs, direct indirect representation, what this means and what are the implications and liabilities, approved consignee premises, routing, clearance, single administrative document, commodity code, procedure code, processing under customs control, inward processing, outward processing, returned goods relief, GSP, which is the Generalised Scheme of Preferences for Developing Countries, preferential trade agreements between the EU and certain third countries, and we're going to finish up with some administrative penalties. The Community Customs Code was legally effective since the 1st of January 1994. And it set out the rules and procedures to ensure the implementation of tariff and other measures in connection with trade between the European Union and non-member states. Now the Union Customs Code has just become effective, legally effective across all EU member states from the 1st of May 2016. Its aims are to modernise customs legislation and procedures, to provide greater legal certainty and uniformity to businesses, to simplify customs rules and procedures, to complete the progression to a paperless and electronic customs environment. And the aim is that by the 1st of January 2021, all IT systems will be fully operational. Customs clearance in Ireland. All goods imported into Ireland from any country outside of the EU must be declared to revenue upon arrival. There are 28 member states in the EU, of which Ireland is a member since 1973. So a country outside of the EU would also be referred to as a third country, such as Canada, China, Australia, South Africa. Goods are declared to ensure that they are moving legally and are not prohibited or restricted in any way. They are declared to ensure that the correct rates of duty, excise duty if applicable, and VAT are collected. Goods are also declared for safety and security reasons, because today customs are facing new challenges. Threats to security are an ever-present reality for supply chain operators. On the one hand, customs must ensure the smooth flow of trade, while on the other hand, they have to apply the necessary controls to protect the health and safety of all of the citizens of the EU. Following is a list of some of the prohibited/restricted goods that are not allowed under any circumstances and if detected will be seized. Drugs, indecent or obscene material, specific weapons, counterfeit goods. And certain products require a licence from the relevant department. So for example, meat products would require a licence from the Department of Agriculture, Food and the Marine, and endangered species would require a licence from the National Parks and Wildlife Service. Customs duty is the same rate in each of the 28 EU member states. The rates are set by the EU Commission and found in the tariff that is updated every year. The tariff is the online customs tariff database. It is a multilingual database in which all measures are integrated relating to tariff, commercial and agricultural legislation. It ensures uniform application by all member states and provides clear information of all measures to be undertaken. In other words, what amount of duty could be applicable. 75% of all duty collected goes to Brussels. 25% stays in each member state. Now, the customs duty is based on a percentage value of the goods. That would be the price paid for the goods, including local sales and taxes, packaging and insurance, plus shipping. So it's a CIF value, cost, insurance, freight value, at first arrival point into the European Union. So if we have a container coming from New York to Dublin and transshipped via Rotterdam, then we are looking at the freight charges up to arrival at Rotterdam to calculate the amount of duty that's applicable. Excise duty is a tax raised by an EU member state, and it is a national tax. So it has to do with inland consumption, and it would be additional to any duty that would be applicable. Alcohol, wine and spirits, tobacco products, oil products such as petrol, diesel and kerosene, betting and vehicle registration tax are all subject to excise duty. VAT is charged at the point of importation at the same rate that applies to similar goods sold in Ireland. There are various VAT rates applicable. There is the standard rate of 23%, and this would apply to most goods. There is a reduced rate of 13.5%, mainly used the residential property, labour costs for building, and would also be for fuel for power such as gas, electricity and heating oil. Antiques over 100 years old would also be rated at this 13.5%, and coins that are classified as collectibles. There is a second reduced rate of 9%, mainly used in the hospitality and tourism sector. There is a rate of 4.8% for livestock. Zero rate would apply to tea, coffee, milk, children's clothes and footwear up to the age of 11, and also aircraft parts and equipment. Now, the calculation of VAT, it's based on the CIF value of the goods, which is the cost, the insurance and freight value of the goods, plus the duty amount, multiplied by the relevant VAT rate, and this would give us the amount of VAT payable. VAT is a national tax and the rate is determined by each EU member state. For example, in the UK at the moment the rate is 20%, Germany 19%, Denmark 25%, France 20%, Poland 23%. VAT-free authorisation, also known as a 13B. Manufacturers can obtain a VAT-free authorisation from revenue once 75% of all production is exported outside of the EU. So this allows them to import free of VAT once all conditions set down by revenue have been met. So the manufacturer would apply to customs to obtain a VAT-free authorisation, and once they have been approved they will be issued with a number, and this number has to be entered on all import declarations to customs. The manufacturer is subject to audit by revenue, and they must keep records on file for inspection and for future audits. Excise duty is still applicable at the relevant rates. There have been a number of electronic customs initiatives introduced to better serve the needs of businesses and customs administrations, while also at the same time increasing the security and safety aspects for all concerned. These would be the Import Control System, the Economic Operators Registration and Identification System, the Authorised Economic Operator Programme. The Import Control System has been established for safety and security risk analysis for goods being imported into the EU from non-EU countries. Basically, carriers have to provide advance notification of all goods en route to the EU, and it is mandatory for them to do so. This notification is sent electronically by way of an entry summary declaration from the carrier to revenue at first point of entry into the customs territory of the community, and the responsibility lies with the carrier. So if we have a container from Montreal to Dublin, transshipped via Le Havre, then Le Havre is the first point of entry into the EU. The Economic Operators Registration and Identification System is a unique reference number that has been allocated to every trader who interacts with customs authorities in any member state of the EU. With a single number across all EU member states, customs authorities are able to facilitate risk analysis of goods traffic, facilitate legitimate trade throughout the EU, and are helped to identify security risks. It is valid throughout the EU and is used by traders in all import and export declarations effective from the 1st of July 2009. National customs authorities in each member state are responsible for assigning the EORI numbers. In Ireland, traders can register online for an EORI number on Revenue's website. The main benefits of the EORI system is the simplification of administration and the enhancement of security. The aim of the AEO programme is to enhance security in the international supply chain through granting recognition to reliable traders based in the EU and encouraging best practice at all levels. Application for AEO status is open to all economic operators established within the customs territory of the EU and who have business activities that are covered by customs legislation. There are specific qualifying criteria. Some of them would be an appropriate record of compliance with customs requirements. There has to be a system in place for managing commercial and transport records which allow appropriate revenue controls. Revenue will carry out audits every now and again. A proven financial solvency. Appropriate security and safety standards are in place. Now, effective from the 1st of May 2016, there has been a new qualification criteria, and this is of professional competence has been introduced. Practical standards of competence or professional qualification directly related to the activity carried out. Goods import into the EU must be declared to revenue electronically through the Direct Trader Input Facility, DTI. This allows importers or their agents to clear shipments at import by electronic data transfer of the single administrative document declarations to revenue. This is completed on the AEP2 system. This system is a direct link to revenue. All supporting documentation needs to be held on file for 3 years for any future customs audit. So that would be 3 years from the end of the year that the declaration is made to customs. Once the SAD has been submitted and accepted by revenue, payment of any duty, excise or VAT must be secured prior to release of the goods. This can be paid by banker's draft or postal order or a guaranteed cheque, or a scheme called the Deferred Payment Scheme, whereby an account is set up with revenue and payment is taken by direct debit on the 15th day of each month. An importer can nominate a person or a company to act on their behalf and to arrange customs clearance. This can take the form of direct representation or indirect representation. In the case of direct representation, the clearance agent acts in the name of and on behalf of the importer-exporter. This means that the importer-exporter is responsible for any customs debt that may arise in the future. If in the future, for example, customs do an audit and it is discovered that there has been an underpayment of duty, well then in this case the importer-exporter is responsible. In the case of indirect representation, the clearance agent acts in his own name but on behalf of another person. In this case, if there was a customs debt, if there was duty, an underpayment of duty for example, both the clearance agent and the importer/exporter are responsible for any customs debt that may arise in the future. A very important issue for companies or clearance agents undertaking customs clearance on behalf of their clients is to be able to produce documentary evidence of being empowered to act on behalf of the importer. You have to be able to produce the document that was issued and signed by the importer/exporter, authorising you to clear goods on their behalf, either on the basis of direct representation or indirect representation. An ACP authorised consignee premises is basically a freight forwarder's or groupage or consolidator's warehouse where they load and unload groupage containers and store cargo. They have been authorised by Customs Revenue and operate under a bond and have to follow strict guidelines and are subject to customs audits and controls. So basically, uncleared goods in a sealed container are permitted to be removed under bond from place of importation to an authorised consignee premises for subsequent unloading and storage, pending customs clearance through the AEP system. So this allows the freight forwarder to have total control over their import consolidation services. Now, they have to provide a bond as security for any duty, tax or levy due on all uncleared goods while held at premises. So if, for example, a shipment is released without being cleared, well then any duty or VAT or any other charges applicable would be due to be paid by the bondholder. They must notify arrival of goods to customs at the Office of Destination via NCTS. NCTS is a European-wide electronic declaration and processing system. It's called the New Computerised Transit System. It is connected through a central domain in Brussels. It provides links between approximately 3,000 European customs offices. So when you send your notify arrival of goods, it's sent on the system and the code is IE007. This is the arrival notification. You're not allowed to remove any seals or open the container until you receive the unloading permission from customs sent via the NCTS, and this will be sent under code IE043, and this will be the unloading permission. Any containers that are called to be examined, the containers have to remain unopened and the seals have to be intact until customs give the go-ahead. Any discrepancies or irregularities that have been found have to be notified to customs immediately, and this will be done under code IE44. This will be the unloading remarks message. And then when customs give approval for the container to be released, that the container can be opened and unloaded, it's given under code IE25, and this would be the release notification from customs. Records have to be maintained to allow customs to carry out effective controls, so all records have to be up to date for any future customs audits, and individual shipments can only be released when clearance has been obtained. When the clearance agent completes the import declaration, the electronic SAD, via DTI on the AEP2 system, it will be assigned a routing. Now this routing can either be green, orange or red. Green is when goods have been cleared by customs and can be removed immediately. Orange is when the hard copy SAD and all supporting documents need to be submitted to customs for inspection. And red, goods have been selected for examination and the hard copy SAD and all supporting documents need to be submitted to customs for inspection. Now, just a little note about the orange and red routings when assigned to declarations are determined by risk profiles. These can be set by local customs offices or by the risk unit in Corporate Affairs and Customs Division. National profiles are run against all declarations regardless of the customs office involved. Supporting documents for SADs. So since the declaration to customs is sent electronically, some of the following documentation may be need to be held. An invoice showing customs value of the goods, a value declaration on form Customs and Excise G563. Now, up to the 1st of May 2016, the value required was 10,000, but now effective the 1st of May 2016, the minimum value of the consignment limit has been increased up to €20,000, and this is in line with the UCC, the Union Customs Code. So anything less than 20,000 does not require a valuation declaration form. origin documents, a movement cert EUR1 when claiming preferential rates of duty for trade agreements. The EU has trade agreements with certain third countries. Goods imported may be subject to preferential rates of duty, i.e. at reduced or zero rates, and if the origin of the goods is in doubt, then the importer will be liable for any extra duties. Bills of lading / airway bill, import licenses where there are restrictions, etc. Now, all copy documents have to be held on file for 3 years from the end of the year in which the goods are released from revenue control for any future inspection or audit. Following are some of the frequently used forms. EUR1 Movement Certificate. It is a cert of origin used as proof of origin when claiming preferential rates of duty on importation from certain non-member states. Custom and Excise Form G563. It's a valuation form, also known as a DV1. After the 1st of May 2016, the minimum consignment limit has been increased from €10,000 to €20,000. So this is in line with the Union Customs Code that has just come into force since the 1st of May, and it replaces the Community Customs Code. Customs and Excise Form 1076, Transfer of Residence. So this application form should be completed by a person transferring normal residence to the state from non-EU countries. And finally, the one we're going to mention last is the Customs and Excise Form 1047. It's a temporary importation. This allows goods to be imported temporarily without payment of duty or VAT. The importer has to obtain a bond or deposit is required, and they also have to stipulate a date when the goods will be exported. The SAD, Single Administrative Document. It's the official declaration to customs sent electronically via DTI, Direct Trader Input, via the AEP2 system. This system is directly linked to revenue. Now, if you have a look at a blank SAD, you'll see one in the appendices. You'll see that there are 54 boxes for completion. From customs point of view, the two most important boxes are box 33, which is the commodity code, also known as the tariff code, and this would advise the rate of duty applicable in the EU, and box 37 is the procedure code. This would indicate if goods are being imported under a special customs procedure, for example inward processing, where the rate of duty will be suspended on importation. So both of these boxes have a significant impact on the duty rate and how the consignment is treated. The commodity code for imports is a 10-digit number. It's also known as a tariff code harmonisation code, which equates to the description of the goods being imported, from which the rate of duty can be determined. Information on commodity codes may be obtained by accessing an EU database called TARC. It's the integrated tariff of the European Communities. This database allows you to search for a commodity code by typing a description or part description of the product in question. Also, if you have the tariff code, you can put the tariff code in and find up-to-date information on the duty rate or any restrictions that may apply. Now, the tariff does not contain information relating to national levies such as VAT and excise rates. There are specific procedure codes for customs procedures that allow goods to be imported for a specific purpose without payment of part or all of the import duties, provided they remain under customs control until the conditions of that particular authorisation is fulfilled. Now, some of the procedures we're going to look at today in this webinar are processing under customs control, inward processing, outward processing, returned goods relief. The processing under customs control is a customs procedure which allows goods to be imported from outside of the EU for processing without being subject to import duties. It only applies to goods that when they have been processed, they have a rate of duty lower than the rate applicable to the goods originally imported. Customs duty becomes payable at the rate applicable to the finished product, when it is released onto the EU market for sale or consumption. Effective the 1st of May 2016, in line with the Union Customs Code that has now replaced the Community Customs Code, the processing under customs control procedure will be merged with the IP suspension procedure. The PCC bond will be cancelled and a new IP authorisation number and procedure code for input on the SAD will be provided. Inward processing suspension is a customs procedure that allows goods to be imported duty-free into the customs territory of the EU for processing. Processing can be anything from repacking or sorting goods to the most complicated manufacturing process. The suspension system means that import duties payable are suspended at importation on condition that security is provided in the form of a bond to cover the unpaid duty. Effective the 1st of May 2016, in line with the Union Customs Code, the authorisation will set down whether the duty on any goods released to free circulation will be on the processed products or on the raw material originally imported. So Customs will assess the particular application and they will decide in advance on what basis the duty will be calculated, and this will be stipulated on the authorisation. Inward processing drawback. Under the Union Customs Code, the IP drawback procedure will no longer be available. All IP drawback authorisations will cease to be valid on the 30th of April 2016. This is because the provision to re-export the goods has been cancelled, and previously the drawback procedure allowed the duty that was paid on importation to be reclaimed on exportation of the goods from the EU to third countries. Traders will be required to apply for IP suspension authorisations before the 1st of May 2016. And what this means is that they will get a new number, an IP authorisation number, and a procedure code for input on the SAD declaration for all future declarations. The holder must also put a bond in place for this procedure. Outward processing is a customs procedure which allows EU goods to be temporarily exported from the customs territory of the EU in order to undergo processing, operations or repair. The resulting products can be released into free circulation into the EU with total or partial relief of import duties. Outward processing enables businesses to avail of the more competitive labour costs outside of the EU while using the EU produced raw materials. Now, I can give you an example of an outward processing shipment that I would have handled myself in the past. This would have been when full container loads of wool were shipped from Galway to India for hand knitting of garments, and then the completed garments were imported back to Ireland. So the raw material was the wool, the processing procedure was hand knitting, and the compensating products were the finished knitted garments, i.e. cardigans and jumpers. Returned goods are goods which have been exported from the customs territory of the EU and are subsequently re-imported free from the payment of import duties. Goods must be imported in 3 years from the date of export, and they must be in the same state and condition as when they were exported. Goods can be returned either because they are faulty or damaged, or not what the customer ordered. Now, revenue requires proof of identity of the goods, i.e. that they are the same goods as originally exported, and also the duty status at the time of original export needs to be established. A good idea would be to get a written explanation from the buyer of the goods as to why they are not suitable and thus have to be returned to the supplier. This can be used as documentary evidence for revenue. GSP, Generalised System of Preferences, is a scheme whereby a wide range of products originating in certain developing countries are given preferential access to the markets of the EU. This is in the form of reduced or zero rates of duty. This is to integrate them into the world economy. A Certificate of Origin Form A is required on importation into the EU. It's very important that this form is correct and valid, because if not, then the importer will have to pay the full rate of duty normally applicable on the goods in question. The Form A is issued by the competent governmental authority in the country of export and is sent from the exporter to the importer. Some examples of countries now that are currently availing of the GSP scheme would be Sierra Leone, Ethiopia, Rwanda, Somalia, Cambodia and Sudan. Preferential trade agreements. The EU has concluded trade arrangements with certain non-member states that allow imports from these countries into the EU at a reduced or nil rate of duty. One agreement is the Cotonou Agreement. It is between the EU and 79 African, Caribbean and Pacific states, known as the ACP-EU Partnership. These special arrangements are known as preferential trade agreements, and the duties involved are referred to as preferential rates of duty. Processed or manufactured products are only eligible for the reduced or nil rate of duty if the goods are accompanied by documentary evidence of origin, such as a movement certificate EUR1 or, in the case of Turkey, an ATR certificate. Importers should ensure that their suppliers meet all the criteria for the origin of the goods and that all documents are in order, because if there is a problem at importation with the proof of origin, then the importer will be liable for the full rate of duty and taxes. The following is a list of some of the countries that benefit from preferential rates of duty. All of the information is available on the TARIC. Section 40 of the Customs Act 2015 provides for application of administrative penalties. These penalties have been introduced to encourage compliance with the Customs Acts and the Union Customs Code. So following are some of the penalties that currently apply. Failure to submit a customs declaration, the penalty is €2,000. Late submission of a customs declaration, the penalty is €250 for each month outstanding. This is subject to a maximum payment of €2,000. Submission of an incorrect or incomplete declaration, the penalty is €100. Not being in possession of documentation necessary to support an electronic declaration, the penalty is €100. So remember that all supporting documentation should be held on file for 3 years, from the end of the year that the goods were released from customs control for any future audit or inspection. So, for example, if the goods were cleared through customs in June 2017, the documentation would need to be held on file until December 2020. Now, in the case of serious fraud or smuggling, administrative penalties will not be applied. What will happen here is that the goods will be seized and, where possible, prosecution for the offence. Well, that concludes our webinar. Thank you very much for your attention. Please be sure to watch webinar 2. This covers a brief demonstration on the use of the TARIC and some sample calculations of duty and VAT for import shipments via air freight and sea freight. If you require any further assistance, please not hesitate to contact either myself, Gráinne Thornbury, or Seamus Kavanagh at the IIFA office, or also Derek Dunn via his email address.